Hello, welcome to everyone. This is CAPTIAL GAIN Part 4 video. Practice 9. Calculate taxable capital gain from the particulars given below. Net concession for a residential property 28 lakh, the stamp duty value is 30 lakh. So we have to consider whichever is higher because the stamp duty value is within 110% of the sale proceeds. Cost of acquisition of the house 3 lakh on 1/5/2007. Index for the year is 129. New house purchased on 1st September 21 for 15 lakh. So this is the transfer of residential property, so we can claim exemption under section 54. Investment in listed shares of Wipro by sale of residential property. Out of the sale proceeds, amount invested in the listed equity shares, so we can claim 54 GB. Invested rupees 2 lakh in the bonds of NHAI after 1 year from the date of transfer. After 1 year, it is not permitted to claim exemption under section 54 EC. Within 6 months from the date of sale, if the amount invested in the bonds, then only we can avail exemption under section 54 EC. So let's see in the answer. Capital asset is house property. Sale proceeds or stamp duty value, whichever is higher, 30 lakhs. Less expenses on sales nil. So net concession is 30 lakh. Less indexed cost. In the year 2078, index is 129, cost is 3 lakh. So the indexed cost for the year 2021-22 of the index 317, the indexed cost will be 7,37,210. Less exemption under section 54, transfer of residential house property. Actual investment is 14 lakhs and the long-term capital gain is 22 lakhs 62,790, whichever is the least is exempted. Next, exemption under section 54 GB, amount invested in the shares of Wipro Limited. So investment into long-term capital gain by net consideration. So the exemption under section 54 GB will be 377,130. So balance 4,85,660 will be taxable long-term capital gain. Here note, exemption under section 54 EC cannot claimed because investment made after 6 months from the date of transfer. In the same pattern, the listeners can practice exercise 9 and check it up the answer. Now let me go for practice 10. Calculate taxable capital gain from the particulars given below. Net consideration for the house property 34 lakhs, stamp duty value 36 lakh 50,000. In this problem also, stamp duty value is within 110% of the sale proceeds. So we can consider sale proceeds or stamp duty value, whichever is higher, as the net consideration. Cost of acquisition of the house 1,80,000 on 1/8/2012. Cost of construction of the first floor during September 2014, and the cost of renovation of the property during January 17. So in this problem, while computing indexed cost, we have to compute cost of acquisition, cost of improvement, and the cost of renovation. 3 stages are there. We must be very aware. New house purchased on 1st September 21 for 18 lakh. So we can claim exemption under section 54. Invested capital gain deposit scheme. This amount is also permitted. So total investment in the new house is 23 lakhs. Let me see the answer. Sale proceeds or stamp duty value, whichever is higher, less expenses on sales nil. Now first index cost of acquisition. First one is the cost of acquisition. Acquired this property on 1st August 2012 for 1,80,000, index being 200. So for the index 200, cost 180 means for the current index 317, it was rounded off to rupees nearest to 10, that will be 285 300. Then index cost of improvement made in the year 2014-15, index 240 for 240, cost is 2,40,000. What will be the current year index for 317? It will be 3,17,000. And the index cost of renovation 2016-17, index is 264, cost 1,40,000. So for the current index 2020-22, it will be 168,110. So the balance long-term capital gain will be 28,79,590. Here we claimed exemption under section 54. The total investment in the new property is 23 lakhs. And the taxable long-term capital gain is 28,79,590, whichever is the least. So balance is taxable capital gain. Okay, in the same pattern, the listeners can practice exercise 10. Now practice 11. Mr. Rana Singh sold a house for rupees 32 lakh on 1st November 21, which was constructed on December 98 for rupees 2 lakh 50 and used for his own residence. The fair market value on 1st April 2001, because it was acquired December 98. So the fair market value was given 4,20,000. Besides, he has two more houses. On 30th November, he invested 8 lakh to specified bonds of NHA, so we can avail exemption under Section 54 EC, and purchased one more house for rupees 12 lakhs. One more, he has already got two more houses. Invested the sale proceeds into another house, so we cannot claim exemption under Section 54. After construction, he spent 1,80,000 in 2014-15 on improvement of the house property. So while computing indexed cost, we have to consider the cost of improvement also. He paid 75,000 as brokerage and other selling expenses for the house. So in this problem, he actually he has two more houses, so we cannot claim exemption under Section 54. That's the main thing in this problem. House property sale proceeds less brokerage paid, balance net consideration less indexed cost. For the year 2001 to 200, fair market value is 4,20,000. So for the current year, index for 317, it will be 13,31,400. And the index cost of improvement during the year 2014-15, index is 240. Cost 180. That cost 180 will be indexed for our financial year 3,317. It will be 237,750. So the balance long-term capital gain will be 15,55,850, less the amount invested in the bonds of NHIA, 8 lakh. So we can claim exemption under Section 54 EC, actual investment or long-term capital, whichever is least. Balance is long-term capital gain. Note, he has two more houses, so we cannot claim exemption under Section 54. In the same pattern, the listeners can practice exercise 11 and check the answer. Now, very important points to be remembered in capital gain. Capital gain exemptions to start up and stand up in India. Section 54EE. New Section 54EE has been introduced in the Finance Bill 2016. The investment in the units of the specified fund shall be allowed up to 50 lakhs. The specified fund shall be set up specifically for start-ups in India. Any advance money forfeited by the owner of the property be treated as income from other sources, not under capital gain. Third one, full value of consideration, 100% is taxable for the self-generated assets like goodwill and tenancy rights. Capital gain account scheme, CGIS. Individual assessee can deposit their capital gain amount temporarily in CGIS and can claim exemption under Section 54 and 54F. Urban agricultural land is exempt under Section 1037 of the IT Act. The stamp duty value does not more than 110% of the sale consideration. Stamp duty considered, sales value be ignored. If stamp duty value exceeds 110%, actual sales value only be considered, and the difference value is taxable and income from other sources when amount of difference exceeds rupees 50,000. Last, tax treatment for bonds and debentures are similar under Income Tax Act. Long-term listed debentures and bonds are not required to indexation and taxable only 10%. Short-term capital gain be taxed as per slab rates. Long-term unlisted bonds and debentures do not require indexation and are taxable at 20% flat rate, and short-term taxable as per slab rate. Okay, good luck to everyone. Bye.